Well, insurance, it is a big, important need for your family. You may, start a family, get the mortgage, have kids, and you want to make sure that if anything happened to you, you are financially protected. We've all been to funerals of people of all ages, and some of those have left families behind that are still young and dependent on them. I'm a big believer if you've got debt and or dependents that you should protect them and protect your income and all that stuff. But Retire Right today, as we get into our 50s, into our 60s, maybe the kids have left home, maybe the mortgage is being paid off, when do you cancel your life insurance? And we are going to talk about it today. We'll jump straight in because Sharon says it really good. And so does Karen. So does Geraldine. How do you know when you're overinsured as circumstances change, e.g. house is now paid off? Karen, is there a common age where people tend to cancel insurances because of cost? Maybe 50s. Sharon, at what point do you jump ship and cancel insurance? Is there a dollar threshold or age, or is it assets versus debt? Assets versus debt. Mate, what would you say to someone, namely Geraldine, Karen, and Sharon?
Yeah, it's always a tough one when it comes to insurance. As you age, the likelihood of claiming on these insurances goes up. So you're more likely to claim, but therefore the cost goes up significantly. So it is always a personal situation. Are you reliant on your income? And will have a really significant impact on your retirement savings if you didn't have that income. And, how do you balance that retirement savings of, my insurance premiums are eating into my retirement savings. And so, there's always a balancing act there. So it is, again, one of the great things that I like to talk about when it comes to personal insurance. It's not an all or nothing. It's not a jump on the ship and keep my $1 million of life insurance or jump off the ship and cancel. You can dial it down. So as you get closer to retirement, it is really important that you are looking at your personal insurance cover within your super fund, and maybe it's just dialing down the cover year on year to keep the premiums the same. So that's one way to really manage that increase in cost, is just bringing down the levels of cover. The worst thing you can do is just ignore your insurances and let it just keep going, because the premiums will really start skyrocketing.
And then I guess secondary from that, just snap and cancel it all.
Exactly, yeah. So. And that's why I've seen that a lot, is, not noticing or paying much attention to my super policies, and then, one day looking at it and going, oh, there's $5,000 a year or $10,000 a year, and, we've got to get rid of it completely because it's really eating into our retirement savings.
Yeah. When Karen said, is there an age where you have to cancel it? This is with insurance and your financial situation, because it's all so personal, and whether your investments, your investment properties, your home, your rent, all your expenses, you can't just think there is a line in the sand for anything financial, because everything is so different for every single person. We had a question in the Facebook group the other day, and they said, oh, what's a good insurance company for my car? Really hard to just hear someone say, oh, GIO or NRMA or AAMI, because what car do you drive? Where is it parked? Is it in a high-risk zone? Is it not? How old is the driver? All that stuff. So it's okay to just say each year, I'm going to review my financial situation based on my current circumstances and make an informed decision. And I think when it gets to that death cover, the disability cover, the income protection cover, as we do get into our 50s, you touched on it. Statistically, it's hammer time for heart attacks, strokes, cancer in our 50s. Just a year on year, because if you don't do that year on year, run your eyes over it, it could be getting really expensive, and you might not need all the cover. I think it's fair to say, and I'll say this and then I'll walk back the comments, if the kids have left home and you've got no debt, there is probably a very, very, very low chance of needing death cover. What do you reckon? And that's I don't want to be that binary, and I'll caveat it, but the debt and dependence are a big thing.
That's right. The only thing I would think about is a lot more Australians are retiring with debt still,
And
with a
later
mortgage.
on.
Yeah. So the actual age of which we are holding a mortgage, it's getting higher and older. So that's the only caveat I would think about. If you still have a home loan, which my parents retired with a home loan still.
Right.
And so that's the only time where you may consider, actually, is it worth keeping? But outside of that, I generally agree with you.
Or if you've still got the home loan, so if you might retire 67, 65, 60, insert date here, the mortgage is still there, might be $200,000. But you've got 900 grand in super, you might step back and take the view, well, there's enough assets in our life. And it goes back to always hunt for the need. Is there a need there?
And and the other thing that it's a little bit crass to say, but if you're in a partnership and one of you pass away prior to retirement, and there's a super balance to fund that debt, it's actually cheaper now to live your life as an individual, financially speaking, and you can clear that mortgage. So there, as you said, there isn't actually that need because that retirement savings can fund that leftover mortgage.
Yeah.
But if there isn't a big pile of money in that retirement savings, then it's a matter of going, well, I know it's going to hamper our retirement savings even more holding this life insurance policy of $200,000, but maybe it's really important still.
Yeah, and I think it is. You kind of led to where I wanted to go, and I'll use my own parents as an example again on this show. Like when they retired, they still had a death policy each, and I think it was a couple $100,000 each. And the way that it was set up, it was really cheap for their age and the level of cover. It was a couple of grand a year, a couple $100,000 in death cover. The need wasn't there at all because they had a good super balance. They had no debt. But I think, and this is the psychology of that retirement thing, just going cold turkey and cancelling it felt a bit weird. I'm like, well, why don't you guys just keep it for a couple of years? If either of you died, financially everyone's going to be okay, but an extra couple of $100,000 is not going to hurt. And then, after time, because they were just reviewing year on year, just made the call. Yeah, you know what? It's been 2 years since we retired. It's going to suck if we cancel it today and die tomorrow. And I think that's the psychology of it.
That's the hardest thing. The what if we need it.
But if you sold your car, would you beg to pay for car insurance each year?
Yeah,
that's right. No, but we're dealing with non-tangibles.
Yeah, and post-retirement is relatively easy. We actually don't need it post-retirement. It's just pre-retirement. And I know we've got some more questions to go through, but Zurich, which is one of Australia's largest insurers, talks about over 20% of people are stopping work earlier than they want to because of their own ill health. So that's the difficulty when it comes to insurance policies and just saying, well, I'm X age, insert age here. I am 55, I am 60, so I don't need these insurances. Well, as we know, and you've done plenty of episodes on the Retire Right podcast about, those last few years of working is really when you start ramping up your retirement savings. So if 20% of people are retiring early, yes, sometimes you've got to balance this. Well, yes, it is a premium cost. It's going to eat into my retirement savings, but will it help fund, this early retirement because of my own ill health or not?
So I think it's important to note we're talking about life insurance, and I think, the last 10 minutes, it's probably been more of a quote-unquote death cover conversation, because in life insurance land, there's the death cover, which is also called life insurance, but there's the umbrella of death cover, total and permanent disability cover, income protection insurance or salary continuance, and trauma cover / critical illness. Now, this is the interesting thing. Let's have the example of someone in their 50s. They turn 53 tomorrow, and they started early with the kids, and the kids have left home. They've done really well with clearing the mortgage, and we are still 10, 12 years from quote-unquote retirement. Then the disability cover enters the chat, doesn't it? Because we have our income protection to produce our income. So it could be that, okay, well, we don't really need this death cover, but we're still working and we still need to generate money because we've got financial goals. And part of that financial goal might be, I'll make a thing up, let's say 50% of our income so we can have a good quality retirement and still do the things that we need to do. So there's still a question there that, well, we still need our income protection insurance because if we couldn't work tomorrow, where is the money going to come from?
Yeah, exactly. Yeah.
And even short term, like a year.
And that's where, you said it right. There's the death cover, which is the life insurance, and then there's the living covers, which is if I'm disabled or if I'm unable to work or if I have a critical illness, well, there is money there to pay for that. And they're actually the policies that go up, considerably in terms of the cost of cover as you get in your, over 50s. But again, it's, and this is the issue when it comes to insurance, life insurance, is there's always this what if something happens just after I've cancelled it. And we've got to take reality as well. And we've got to take our feelings into the case. But, as I said, back on that stat, over 20% of people are finishing work early and not able to hit their retirement savings goals because of their own ill health. A big percentage of people, over 15% are retiring early because they're caring for someone else. So not even just their own ill health, but someone else's ill health as well, which is not an insurable thing. We can't insure our, caring for someone else. But there are a lot of cases about, well, we're retiring early, we're shortening that, our Excel spreadsheet says I'm retiring at 55 exactly on the dot and I will have X amount of savings. There are these things that we've got to plan for. So sometimes having a buffer when it comes to insurance that, yes, it's costly and it will impact our long-term retirement savings, but will it have a benefit that we want to pay for?
And, back to that income protection thing in our 50s, house could be paid off, awesome, kids are left home, awesome. Oh, this income protection's, it's getting up there in costs. Well, okay, let's look at what we can do to reduce the premium. Do we bump out, we're still on a 30-day waiting period. Let's bump that to 90 days. We probably don't need to insure the full income because, we could maybe beg, borrow and steal, but we just want a little bit of cover in there.
Yeah.
So can we reduce the insured amount to massage that cost?
That's right. And if you're doing any transition or retirement strategies and putting a lot of money into your super savings, maybe, yes, it's going to increase impact our retirement savings and we're not going to have as much, but we're going to reduce our savings. So yeah, let's only cover 50% of our income or 40% of our income. And that's really where I say review every year and come back to it and go, is this important to us? And so, so we don't get to the 5 years in and you look at the last 5 years of premiums, you get really grumpy and then you cancel it, which is, what I tend to do is get grumpy and snap. Yeah, exactly.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.